Good morning. You're watching live daily market outlook for Monday, 31st of October 2011, prepared by Windsor Brokers. Today's main top news are the intervention of the Japanese Central Bank, as announced earlier and mentioned in our previous sessions. The Bank of Japan officials announced this earlier that they are ready to intervene at any time in order to stop further strengthening of the Japanese currency that directly harms the economy and the exports. So today, after initially hitting the fresh record low at 75.56 during the night, in the early hours, the late hours of Asian session, the Bank of Japan sold the yen. It's this second time in less than 3 months. Saying they intervened to counter the speculative moves that were hurting the economy. The finance minister Azumi said Tokyo stepped into the market on its own, and it was at 1:25 GMT exactly, and they are ready to continue to intervene until they reach the satisfying results. The Tokyo's latest foray into currency markets followed weeks of warnings that its patience with the yen's strength was wearing thin, and came just days before the group of 20 leaders, G20 leaders summit in Cannes, France, where the summit will focus on Europe's efforts to contain its sovereign debt crisis and avoid the repeat of the financial shock that hit the markets after the Lehman Brothers collapse in 2008. Back to the European crisis, the things seem to be not as bright as originally looked, and actually the very positive sentiment that was persisting during the past week, especially supported by some good news from states, showing that third quarter GDP was significantly higher from the second one, averting actually immediate risk of the further of the entering recession of the United States. Actually, were quite supportive for euro, and it rallied during the past week, hitting the fresh high at 142.46. That was on 27th of October. However, at this point, we can see that positive sentiment is slightly fading, as also some news coming from the other countries such as Japan and China, where the EFSF had traveled last Friday to ask for support. Actually, the agreement was made within the European Union heads. However, there was not sufficient money to implement the whole plan, so they were looking for help from the other economies. The Japan also said something similar to the Chinese. They said to the head of European bailout fund that they will continue to buy bonds, but like China, they did not commit putting cash into the special purpose vehicle to enhance the rescue fund's firepower. Also, other potential buyers such as Brazil and Russia have indicated that they are willing to support the Eurozone, either through the IMF or bilateral talks with individual member countries. So this is a bit now disappointing at this point, sort of slightly pessimistic. However, this is quite realistic, as I mentioned in the previous two sessions. Agreement has been reached, but they need to find the money in order to prevent. Also, the comments were that if the European Union will be using their credibility if any country that comes in the financial troubles need to be rescued by some other countries, not by their own efforts and the efforts of the a group of 17 European Union countries. Now we'll see the further developments of this plan, how it's going to be. Need to mention that, however, the Euro's positive sentiment on the wider picture still remains intact despite today's intervention and strong rally of the dollar across the board. But near-term focus is now turned to the opposite side. In the case of euro and sterling, it's more to the downside. Also, the commodities fell after a broader strength of the dollar following by intervention of Bank of Japan, and keeping the upside for the time being in the near-term outlook aside, and turning focus lower. From today's calendar, slightly disappointing news from Germany came as retail sales came at disappointing 0.4% compared to the 1.1% forecast. However, the previous month release minus 2.7%. Today's release compared to this is good, but disappointing in a way that came much lower than the forecast. Further to come today is from UK net lending for individuals monthly. Slight decrease was expected to 0.9 billion compared to the 1 billion pounds in the previous release. M4 money supply monthly from UK also at 10:30 at the same time with the net lending to individuals. 0.3% is expectation for today versus the minus 0.2 the previous month release. And mortgage approvals slightly to decrease. Forecast for today 51,000 versus the 52,000 previous month release. At 11 o'clock GMT from Eurozone, CPI flash estimate yearly rate is expected to come at 2.9%, one tick below 3% previous release, while unemployment in Eurozone is expected to stay unchanged at 10%. Also from Canada, in the afternoon at 13:30 GMT, GDP expected to slightly drop to 0.2%. That is today's forecast compared to the previous month release at 0.3%. From US at 14:45 GMT, Chicago PMI also expected to decrease to 59.2 compared to 60.4 the previous month release. Now let's take a look on the charts and see the developments in the market in past couple of hours after the intervention of Bank of Japan. As I said, the sentiment on the near term has changed negative. We can see that euro hourly studies are now in the negative territory, and basically reversal from last Thursday's high at 142.46 initially took the mild correction and consolidating here until the intervention occurred, sending it below 141 and then 140 as the psychological barrier. Low of day was hit at 139.74, which is equivalent to the 26th of October high, and just ahead of the recent consolidation ceiling at 139.55 zone. The near-term outlook is now into negative territory, and the downside for now remains favored as pair holds actually above against 140 barrier. However, 140.70 approximately 141, let's say, needs to be regained in order to turn the focus higher, with the 20 days moving average on the hourly chart currently at 141.06 and pointing lower, maintains the current bear trend. Loss of today's low at 139.74 to turn immediate focus lower, and opens 139.55 zone, and then further losses to look for test of 138, the high low of 26th of October, and the key support at 136.55. This is the higher platform of 18th, 20th of October lows. Loss of this level would turn the wider picture outlook more negative, and mark the high at 142.46. On the daily picture, we can see that brief break of the main bull trend line support is now weakening the structure. However, daily studies are still in the positive territory. Important to say, loss of 200 days moving average that is currently at 141 further weakens the structure, and unless this level is regained, as I mentioned, the 141 as a key barrier on the upside, the focus, near-term focus would remain to the downside. But a wider picture is outlook is still in the bearish mode, as long as holding above 137, 136.55, which also marks near 38.2% Fibonacci retracement of the move from 131.45 up to 142.46. Cable was also significantly lower this morning after the intervention as the dollar rallied higher, and the loss of key supports at 160.70 and then psychological support at 160, where also the trend line, main bull trend line, drawn from 152.71 low of 6th of October, further weakens the structure. Temporary support was found at 159.64. This is the low of the day, ahead of strong supports at 159 and 158.90 lows, below which would further weaken the structure. Current bounce is attempting to hold the gains above 140, but for now is seen corrective, as long as 160.70, the low of 28 last Friday's low, and 20 days moving average on the hourly chart currently at 160.77 and pointing lower, caps the upside. Break above 160.70, 161 is to turn the focus higher and resume the broader uptrend, and the immediate barrier is at 161.51. Until then, near-term focus remains to the downside, as the studies are still pointing lower and holding below their midlines. As I mentioned, the loss of 159.64 opens 159.00 and then 158.90, pardon, ahead of strong support at 158.50 zone, which is the ceiling of the recent consolidation range. The dollar yen benefited greatly from the intervention after hitting a 75.56 fresh record low that I mentioned already in early presentation, and we can see sharp rally. It regained all the immediate barriers: 77, 77.50, 77.85, 78, 78.45, and extended gains to 79.52 so far. We can see better on the daily chart, just short of 80 zone, 80 as a figure resistance, and 80.23 the high of 4th of August. However, the pair managed to reach the previous range, consolidative range low at 79.55. The immediate outlook for dollar yen remains positive. However, overextended studies are already in the corrective mode. The previous high at 77.85, so we have 78 and 77.85 offering initial support, and while holding above the later, the near-term focus remains on the upside. Loss of 77.85 would risk return to the over 2 months range, and proved significant results actually of the current intervention. While holding above here keeps the focus higher, as the near-term studies are still in the positive mode, and possible extension higher towards 80, 80.23, and then further extension higher that might also target 80.23 and 80.50, which is the 50% Fibonacci retracement of the broader down move from 85.51 down to 75.56. Dollar Swiss is in recovery mode, actually extended recovery that was backed by today's intervention after hitting fresh multi-week low at 85.66 last Thursday. It's significant, as we can see on the daily, that the pair is attempting to break above, actually it broke above briefly the 200 days moving average that currently stands at 87.32. 87.38 was the low, was the high of the day, holding above 200 days moving average would turn the immediate tone more positive. That will be actually correction of the correction. As we can see on the daily, the main trend is still to the upside, and then we have short-term correction that was contained at 85.66 for now, just above 50% Fibonacci retracement of the uptrend from 77.10 up to 93.13. Holding above 200 days moving average would open the next level at 88.86, the main bear trend line, and 88.60 actually the previous high. So we will be looking for a further extension higher. On the downside, holding above 86.90, which is actually 86.71 is today, so we have lost the initial support at 86.90. 86.50 is the next strong support, and holding above here would keep the immediate tone higher, while break below 86.50 would open way for a further extension lower and possible test of 86 zone, which was the near-term corrective range, consolidative range floor, and further weaken the tone for possible retest of 85.66. Commodities were also affected by today's intervention, as the dollar soared higher, and the commodities as immediate reaction were slightly lower. However, the crude oil maintains still a sort of positive tone. Actually, it's in the sideways trading within the consolidative range after hitting fresh high at 94.58 on 25th of October. The broader picture shows that the gains were capped for now at 95 zone, which is the 61, approximately 95, it's around 94.85. 50% Fibonacci retracement of 114.80 down to 74.94 descent, and while holding here, it might take some more time for a consolidation, but on the downside, it's important to stay above 90 support in order to keep the positive tone in play. The studies are positive on the daily outlook, and our main target is at 95, above which to open way for further extension and possible test of $100 per barrel, which is our main psychological target, and it's also the 61.8 Fibonacci retracement of the down move. Gold is still in the corrective mode, extending losses down to 17 zone, which is now the strong support, the previous resistance area, and immediate tone on gold is negative. The hourly studies are now in negative territory. However, holding above 1695, 1700 keeps the broader outlook from 1532 and the higher low, and at 1603 still in play, as the recent broader picture recovery retraced over 50, between 50 and 61.8% of the downtrend from 1920 record high down to 1532. So on the wider picture, the holding above 1695, 1700 keeps the immediate tone positive, where also comes to a 90 days moving average on the daily chart. On the near term, the outlook is, as I mentioned, more negative. However, the oversold conditions see scope for some bounce higher, with initial barrier coming at 1740 and 1732, the 20 days moving average that is still pointing lower in 1740. And for now, it looks like it's going to cap the upside break above this to refocus 1752 previous high and resume recovery. A loss of 1695 would delay and open way for further extension lower, with the levels at 1675 and 1660 to come next on a break.